Hello, this is David Starr with Simpler Trading, and today I want to talk to you about the Hindenburg Omen. We'll talk about what this signal is with an ominous name that gave us some indications here in the markets prior to making an all-time high here in January of 2022 that led to significant declines. Currently, the lowest low we've seen in the pullback is right here at this low, October 13th. And here, as I'm recording this on October 31st, we've bounced a little bit. And we want to understand a little bit about what the Hindenburg Omen signal might, I repeat, might be telling us now for current markets. So first of all, what is this signal? Because you can see we did get a lot of these indications right here immediately prior to the market's all-time high, at least shown on the NYSE Composite Index, which is what I'm showing on this chart. Of course, other broad market indices topped at about the same time, the NASDAQ a little bit earlier, right? But you can see we were getting a lot of these signals in here prior to that market top. And then we rolled over and had a significant decline. So first of all, what is this signal? It has a few different components that lead to this indicator I have on my chart, printing these lines that say Omen, right? And these are generated using a few different conditions. The most important one has to do with the number of new NYSE 52-week highs, which are broken out on this panel down here, these levels in, or this line in green, and then I'm also showing this line in red, which is the number of new 52-week lows. And in general, right, markets are rising generally more than they're falling, although we see phases of both, right? And when they're rising, it's no surprise that we see a bunch of new 52-week highs, that the green line here predominates. And also no surprise that when we do go into those downtrends, that the red line predominates. And that makes some general sense, right? However, there are going to be periods of time when the markets aren't necessarily well behaved, when we will have a number of both new 52-week highs and new 52-week lows at the same time. That generally is a confused market, and a confused market is often a market that is not well behaved. And that is one of the main things that the Hindenburg Omen looks for anticipating declines that might be significant. So overall, the way we define, for the purpose of the Hindenburg Omen, a lot of new 52-week highs and a lot of new 52-week lows at the same time is as follows. We take the total number of symbols on the NYSE, or actually a proxy for it. We calculate this by taking all of the symbols that are up on a particular day, right, and all the symbols that are down on a particular day, and add them together. So we're excluding some of these zombie symbols on the NYSE that don't move at all, right? So the number of basically unchanged symbols on a day that we calculate by adding the advancers and the decliners. And once we get that number, we take 2.8% of it, right? And if the number of NYSE advancers, the number of new NYSE 52-week highs and the number of new NYSE 52-week lows are both greater than that 2.8% number, which is generally in the 80s, right? So more than 80 some odd stocks making new 52-week highs, and the number of new stocks making new 52-week lows also above 80 something, then that generally leads us to have this first condition, the most important condition for the Hindenburg Omen, right? A lot of new 52-week highs and 52-week lows on the same day. Now, there's one other thing that we use to kind of filter out some conditions that don't tend to lead to those declines, and that is if the number of new 52-week highs is more than double the number of new 52-week lows, then we exclude that for the purpose of generating a Hindenburg Omen observation. So, as an example, if we had 90 new 52-week lows, which on most days would be enough to generate an observation if the number of new highs was also playing along, but we had 200 new 52-week highs, right? More than double the number of new 52-week lows, then that would not be an observation. If we had 100 new 52-week lows, 150 new 52-week highs, then that would. And so you can see back in here, both these red and green lines were a little bit elevated off the floor, and that was enough to give us an indication because it happened along with the next condition, and that is that this 52-week, that this 50-day moving average, right, of the NYSE composite is rising. Right? So we have to have the condition with the new 52-week lows and new 52-week highs met, and the 50-day moving average of the NYSE composite has to be rising. And if we get all of that going on, then it generates a Hindenburg Omen observation. And whenever we get an observation, it tells us that for the next 30 days, that any day in which the McClellan oscillator, which is the blue line on this chart, any day when the McClellan oscillator is below zero in that 30-day window is a day when we're more likely than usual to see significant declines. And so that was a warning that we could see some significant selling through here, a warning that was refreshed right back in April of 2022. And again, it saw continued selling from there. So that is our basic Hindenburg Omen observation. Now, right now we're in a phase where the 50-day moving average of the NYSE composite is falling. So unless we get up high enough that that we can again draw this 50-day moving average positive, we're not going to get a fresh, full Hindenburg Omen observation. So is this still meaningful in this environment with us not bouncing? Well, where we are right now is, we're about 50 trading days beyond these right here, kind of a few days after this August 16th high. So the moving average is going to be rising if we're above the close from 50 days prior. It's going to be falling if we're below the close from 50 days prior. So if we keep heading up here, or if we stay at the current price levels as price comes down off of that August high, then either way we could get above the high from, or the close from 50 days prior, and drag this positive, right? So that is one way that we could generate a new Hindenburg Omen signal. But remember, if we get a new 52-week high and 52-week low condition here, it's in a spot where we're already sold off significantly from the all-time high. So I want to come in and look at where we ran into a similar situation back in the 2007 to 2009 sell-off, and see if we can see some comparisons, right? Because this was an indication that gave us a strong warning back here before this market started to roll over that we might see some selling. Now, with the Hindenburg Omen, that's right. It is very unusual to see the amount of selling that we saw here so far this year without having a Hindenburg Omen first. But before we look at some of these parallel conditions, I want to draw your attention to what we were seeing back here in early 2021. We were also getting some Hindenburg Omen signals, and they didn't lead to a sell-off. And that's something we have to keep in mind with this signal and its and how reliable it is, right? You can look at this in two different ways. One, the fact that it's very rare to see a significant sell-off without a Hindenburg Omen may cause you to think it's extremely reliable, right? That is false negatives are very rare. It's very rare to have a sell-off without a Hindenburg Omen. But false positives are very common, right? That is, while we don't see these signals every day in a positive market like we were seeing for a couple of years leading up to this January's high. We will see them, and there will be a decent percentage of them, maybe 25% or so, that don't lead to significant selling. So we have to factor that in to our view of reliability. Now, with that said, I've got to look at a different chart to in a different charting package to show you what stuff looked like in that 2007 to 2009 sell-off. This Thinkorswim chart that I'm showing you right now does not have the new 52-week highs and new 52-week lows broken out back in 2007 to 2009 data. But I do have that data available here from TradeStation. The problem is I can't show you the NYSE composite back for those years, and so I have the S&P 500. It's still going to reasonably turn at similar times as the NYSE composite, but it's not going to be exactly the same, right? But we can still see that we had this all-time high back in October of 2007, right? And let's just mark that on our chart here quickly. And you can see that right after that, we have these blue dots on our screen, right? So blue dots right down here. Now what these are, this is not the full Hindenburg Omen observation. The blue dot is printed when the combination of new 52-week highs and new 52-week lows is met, and then you have to look and say, is the 50-day moving average still rising? In this case, it is here on the S&P 500. It was on the NYSE composite as well, and so these were Hindenburg observations before this market started selling off significantly, right? Then we got a bounce and more downside, and then we got another bounce in here, and then the market started selling off significantly, right? Now, back here in September of 2008, before the decline really started to accelerate down into the low, we've got fresh new 52-week high and new 52-week low observations, right before the selling really accelerated. But it happened because we were already sold off so far from the all-time high with these observations back in late 2007, right? The 50-day moving average was still downward sloping. So that's what we were looking at back here in late 2008 before these significant additional pushes to the downside. And if we look here on this chart, give me just a second. All right, if we look here on this chart at current time, we'll see something similar, right? Back here on October, what was this? This was last Friday. It's currently the 31st. So this would have been the 28th, right? Friday the 28th. You can see we got one of these blue dots again. This says that we've got a significant number of new 52-week highs and new 52-week lows here at the most recent bar on this chart. And so if I get my drawing tool back up here to show this to you, you can see, right, we've already gotten a decent decline, right? And then a decent bounce. And like before, another decline and another bounce. And now we're sitting here looking at a spot where maybe this turns back down. So here's what I want to pay attention to, right? This one will, unless we bounce more first and get a new indication with new 52-week highs and new 52-week lows, when the 50-day moving average is rising, this may be all we get. But look at the McClellan oscillator back here. It is well above the zero line. So right now, with the market rallying off the October 13th low, unless we get some other indication that we're starting to roll over, right, there's nothing to be too worried about yet. But if we do start rolling over, and particularly if it takes the McClellan oscillator below zero, then that would be a warning that we're turning back down. So I would certainly be watching this advance from the October 13th low, and particularly so long as it stays below this August high, this August swing high that we saw. And if we start to see signs of short-term topping, realize that there is a potential signal on the clock for, let's say, the next 30 days or so, or longer if we get fresh new 52-week high, new 52-week low observations that could warn of a turn back down. But because of the frequency of false positives, actually look for signs that this is rolling over through the McClellan oscillator or other tools that you might want to use. I'll be looking at things from an Elliott wave perspective as well. And if it does roll, recognize that there is the potential for significant additional selling. So that's how I'll be interpreting the Hindenburg Omen going forward, at least starting from the end of October 2022. Of course, this information about the Hindenburg Omen itself is relevant at any time, so hopefully you now know how to process that, as well as some of these other indications if they arise that may have parallels to what we saw in 2007 to 2009. I hope you found that useful, and I look forward to seeing you again soon. Until then, as always, good trading. Hey, David here with Simpler Trading. Thanks for taking a few minutes to watch this video. I hope you found it useful. And if you did, please help us out. Click the like button. You can also add your comments below. We love to read those and respond to them. You can also click the bell icon. That will alert you whenever we have new and updated videos. And if you want to watch us trade in real time with our own money, you can visit simplertrading.com to learn how to sign up. Until I see you again, as always, good trading, and we'll see you at the next video.